If I told you that nearly 40% of everything you will earn across the entire working life is quietly disappearing into a system you never actually agreed to join, would you want to know exactly how that happens and exactly how the wealthiest families in the world have already opted out of it? Here's the part almost nobody says out loud. That 40% isn't a law of physics. It's not gravity. It's a set of choices, defaults really, and the families who've escaped them didn't do it by cheating. They did it by building something. Right now, somewhere in this country, there's a household sitting on a portfolio worth tens of millions of dollars, and their effective tax rate is lower than the dentist down the street pulling in $200,000 a year. Same country, same tax code, completely different outcome. The difference isn't the income, it's the structures sitting underneath it. Today, I'm handing you the blueprint for 3 of those structures, 3 shields that the middle class almost never hears about because nobody profits from telling you. By the time we're done, you'll understand exactly why this gap exists, how each shield works, and the first move you can make this year to start building your own version of it. Before we go any further, I want to plant a flag, because this is the entire reason this channel exists. We don't follow the market here, we design the moat. Following means reacting. Reacting when tax season shows up, reacting to a headline, reacting to whatever a filing program tells you to click next. Designing means the structure is already built, long before any of that happens, so there's almost nothing left to react to. In a world full of followers, we are the architects of our own freedom. Everything I'm walking you through in the next half hour is what that sentence looks like when you actually build it. So let's start with the divergence itself, because if you don't understand why this gap exists, the 3 shields are going to feel like tricks instead of tools. Here's the core of it. The tax code at its foundation treats 2 things very differently: money you earn by trading your time and money your assets earn just by existing. If you're on a salary, almost every dollar that hits your account is already been taxed before you see it. Income tax, payroll tax, the works. There's no delay, no flexibility, no choice in the timing. The system collects first and asks questions never. Now, look at how appreciation is treated. If you own a piece of real estate, a stock portfolio, a business, and it grows in value, that growth isn't taxed while it's just sitting there growing. It's called unrealized, and unrealized gains, no matter how large, generally aren't touched until you do something that triggers what's called a taxable event, usually a sale. Until then, that growth just sits there, compounding, untouched. Picture 2 people, each starting with the exact same $10,000. One keeps it somewhere that gets taxed every time it grows. The other puts it somewhere that simply grows, untouched for 10 straight years. Same starting point, same market, same return. By the end of that decade, the second person isn't just a little ahead. The gap between them is 10 years of tax that never got collected, sitting there compounding on top of itself. That gap stretched across an entire working life is most of where the 40% we open with actually comes from. That single distinction, earned income versus unrealized growth, is the seed of everything we're about to talk about. The middle class path is built almost entirely on the first category, a paycheck taxed at the source, spent to live, with whatever's left over going into accounts that get taxed again later. The wealth-building path runs almost entirely on the second category, assets that grow quietly, that are never sold if it can be avoided, and that are restructured, not sold when money is needed. Here's another way to see it. Take 2 people earning roughly the same amount in a given year. One is an employee, one is the owner of a small business. The employee's income arrives as a single number on a pay stub, already reduced before it ever reaches their account. The business owner's income arrives as a much messier picture: revenue, expenses, equipment, a vehicle, maybe a portion of a home office. And the tax code lets almost every one of those pieces interact with the final number before it's taxed at all. Same effort, same rough income, 2 completely different relationships with the tax code. One person is handed the result, the other person is handed a set of levers. None of this is a recent discovery either. This divergence has been built into the structure of taxation for generations. It's just that the playbook for using it has historically lived inside law firms, family offices, and accounting practices that don't exactly run advertising campaigns. The information was never classified. It just never trickled down because there was no incentive for the people who understood it to explain it to anyone outside their existing client base. That's the actual gap we're closing today, not a legal gap, an information gap. Here's the part that should genuinely bother you. None of this is secret. It's published. It's written into the code. The reason most people never benefit from it isn't that it's hidden, it's that it's built for a different starting position. It assumes you already own appreciating assets. It assumes you already have a structure. And if you don't, the entire second pathway is just invisible to you. You're standing right next to the door and it doesn't even register as a door. That's what I mean when I say a moat isn't a reaction, it's a position. The 3 shields we're about to go through aren't loopholes you exploit once a year in April. They're positions you build slowly so that more and more of your financial life happens on the second pathway instead of the first. Let's start with the one that has the most immediate impact on how you actually live day to day. Shield number 1 is the one that quietly funds the entire lifestyle of a huge number of wealthy households, and almost nobody outside that world realizes it's happening. It's called asset-based lending, and the short version of the strategy is this. Instead of selling an appreciated asset to get cash, you borrow against it. Think about what happens when you sell. Say you've got a stock position. It's grown significantly over the years. The moment you sell, that growth becomes realized, and realized gains get taxed. Depending on how long you held it and your income level, that could mean handing over a meaningful chunk of that gain before you ever get to spend the rest of it. Worse, you've also removed that asset from your portfolio entirely. It can never grow again because it's gone. Now, here's the alternative. Instead of selling, you go to a lender, often the same institution holding your portfolio, and you open what's typically called a securities-backed line of credit. You pledge the portfolio as collateral, and the lender extends you cash, usually at a fairly favorable interest rate, because the loan is fully collateralized. That cash isn't income, it's a loan. Loans aren't taxable events.
You can use it to buy a home, fund a business, cover living expenses, whatever you need, and your original asset stays exactly where it is, fully invested, continuing to compound. Now, I want to be straight with you here because this channel doesn't do hype without the other half of the picture. This shield has a real risk built into it, and it's the same risk that's wiped out people who used it carelessly. If the value of your collateral drops sharply, the lender can issue what's called a margin call, requiring you to either post more collateral or pay down the loan immediately, sometimes by force selling the very assets you were trying to protect. The families who use this well aren't borrowing right up to the edge. They're borrowing conservatively, often well under half of what they could technically access, specifically so a market downturn doesn't turn their shield into a trap. There's a math question underneath all of this that most people never stop to ask, and it's worth slowing down on. When you borrow against an asset, you're paying interest on that loan. So the real question is the interest cost on the loan less than what you would have lost to taxes if you'd sold instead? In most environments, the answer is yes, often by a significant margin. If selling would have triggered a tax bill representing a double-digit percentage of the asset's value, and the loan cost you something closer to a mid-single-digit interest rate per year, you come out ahead by borrowing, sometimes dramatically. And that advantage compounds every year you stay in the loan rather than selling, because the underlying asset is still growing the entire time. This is also where the psychology of never selling becomes a financial strategy, not just a mindset preference. The families that have been building wealth across multiple generations don't think about their core asset positions in terms of when they'll cash out. They think about those positions as permanent, as infrastructure, as the base everything else is built on top of. The cash they need for living, for investment, for opportunities comes from borrowing against that base, not from dismantling it. It's a completely different mental model from what most of us were taught about money, which is essentially earn, spend, save what's left. The model we're talking about is build, hold, borrow, grow. Here's where it gets really interesting though, the part that explains why this strategy has a nickname in financial circles: buy, borrow, die. In many cases, when an asset passes to your heirs after your death rather than being sold during your lifetime, its cost basis can reset to its value at that time, what's often called a step up in basis. That means decades of embedded growth that was never taxed during your life can in many circumstances pass to the next generation without ever triggering the capital gains tax that would have applied if you'd sold it yourself. The loan gets settled from the estate, the asset transfers with a fresh basis, and an entire lifetime of unrealized growth simply never gets taxed at the rate it would have during a sale. That 3-word phrase, buy, borrow, die, sounds almost flippant when you first hear it, but when you understand the math sitting underneath it, it stops sounding flippant and starts sounding like the most rational long-term capital strategy ever constructed. It's not morbid, it's architectural. You're building something that functions completely differently from a paycheck and portfolio approach because it was designed for a completely different purpose, not to generate retirement income, but to generate perpetual family capital. That's shield number 1. You're not avoiding anything illegally. You're simply choosing not to create a taxable event and using the asset itself as the source of liquidity instead. It's a mindset shift as much as a mechanical one. Stop asking, how do I cash this out? And start asking, how do I use this without cashing it out? And if you've already watched the video where I broke down the 10-year wealth mode, this is the engine sitting underneath it. That strategy works because of this exact mechanism, just applied patiently year after year. Shield number 2 lives in real estate, and it's built on a concept that sounds almost backwards the first time you hear it. An asset that is going up in value on paper, going down in value for tax purposes. Here's how that's possible. The tax code allows owners of income-producing real estate to depreciate the building, not the land, but the structure itself, over a set number of years, on the theory that buildings wear out over time. Even if the property is appreciating in the real world because the neighborhood is booming, the tax code still lets you claim a portion of that building's value as a deduction every single year. That deduction can offset the rental income the property generates, sometimes reducing the taxable income from that property close to nothing, while the actual cash flow stays positive and the actual market value keeps climbing. Now, here's where it gets faster. Instead of spreading that depreciation evenly over decades, owners can commission what's called a cost segregation study. A specialist walks through the property and identifies which components, flooring, certain electrical and plumbing elements, fixtures, landscaping, parking areas, actually qualify for much shorter depreciation timelines than the building as a whole. Those components get pulled out and depreciated on an accelerated schedule, which front-loads a large portion of the total deduction into the very first year or two of ownership, instead of spreading it thin over 30 or 40 years. Let me make that concrete, because numbers are where this becomes real. Picture someone who purchases a rental property for $500,000. Under standard straight-line depreciation, they'd claim roughly $15,000 or $16,000 as deduction each year. That's useful. It offsets some of the rental income. But a cost segregation engineer comes in, walks the property, and determines that a meaningful portion of the purchase price represents components with 5, 7, or 15-year lives, rather than the standard residential timeline. In the first year alone, instead of $16,000, the owner might be looking at a deduction many times larger. A first-year deduction that runs deep into 6 figures on a property of that size is not unusual. The property didn't change, the value didn't change, only the timing of when the tax code allows the deduction to be claimed changed. And in the year you need it most, that difference can be decisive. And here's the piece that's changed the game most recently. Recent shifts in tax legislation have expanded how much of that accelerated depreciation can be claimed immediately in the year the property is placed in service, rather than spread out. For someone who owns or acquires the right kind of property at the right time, that can mean a deduction large enough to offset a meaningful slice of income from completely different sources. Not just the rental income from that property, but other active income too, depending on how your involvement with the property is structured.
That last part matters, so let's not gloss over it. There are rules, usually grouped under what's called passive activity loss limitations, that generally restrict using real estate losses to offset your salary or business income unless you meet certain thresholds of involvement in real estate as an active part of your work. This is exactly the kind of detail that separates someone who reads one article and gets burned from someone who builds this properly with a team that understands their specific situation. The deduction is real. The structure around how you qualify to use it is what makes or breaks the outcome. There's one more piece of this shield that almost nobody mentions when they talk about depreciation, and it matters for the long game. The deduction you take today doesn't disappear permanently. When you eventually sell the property, there's a provision called depreciation recapture that can bring some of that deferred tax back due. The key word there is deferred. You've held on to that money, sometimes for years or decades, letting it sit inside your asset base, growing and compounding the entire time. Even when recapture eventually comes into play, you've had the economic benefit of that capital for the entire holding period. And if you've structured things well, a 1031 exchange, which allows you to roll the proceeds of one investment property sale directly into a new property without triggering immediate tax, can push that recapture event further into the future, sometimes indefinitely, sometimes across generations. The depreciation engine and the exchange mechanism working together is one of the most powerful long-term wealth preservation tools the tax code actually offers. What I want you to take from this shield isn't go buy a rental property tomorrow. It's this. Real estate is one of the only asset classes where the tax code is actively designed to make ownership cheaper the longer you hold it, even while the asset itself is becoming more valuable. That's not an accident, and it's not something that's going to get closed quietly. It's policy, baked in, because the system wants people to own and improve property. The middle class tends to interact with real estate as a place to live. The wealth-building path treats it as a tax-advantaged engine that happens to also be a place someone else lives in, paying you rent. Now here's where most people switch off, because this next part doesn't sound like a tax strategy at all. Stay with me, because it's actually the one that makes the other two work at full strength. Shield number 3 is the one that ties the first two together, because it's not really about a tax technique at all. It's about where, legally, your assets and your income actually sit. And the wealthiest families think about this with the same seriousness most people think about which bank to use. Let's start with the simplest version, where you live. In a country where some states charge meaningful income tax and others charge none at all, your state of residency is functionally a choice, and for a growing number of people, especially anyone with remote or location-flexible income, that choice has become one of the highest leverage financial decisions they'll ever make. Establishing genuine residency in a no-income tax state, done properly and documented correctly, can mean income which would have been taxed twice, once federally and once at the state level, is now only taxed once. Multiply that across decades of earning, and the number gets large fast. Now layer in the next piece, trusts. When most people hear trust, they picture something for ultra-wealthy families passing down mansions. But a trust, at its core, is just a legal container, one that can hold assets, with its own rules for who controls them, who benefits from them, and critically, how they're taxed. An irrevocable trust, set up correctly, can move assets out of your personal taxable estate entirely. Depending on how the trust is structured, whether it's a grantor trust, where you're still treated as the owner for tax purposes, or a non-grantor trust, where the trust itself becomes a separate taxpayer, the income those assets generate can end up taxed in a completely different way than if you'd held those assets personally. Now, here's why the non-grantor distinction matters so much. In a grantor trust, you're still the owner for tax purposes, which means the income is taxed on your personal return, but you retain more control. That can actually be useful in certain estate planning strategies because you can pay the tax on trust income yourself, which effectively lets the trust grow untouched while your personal estate shrinks, achieving a transfer of wealth in a way that doesn't show up as a gift for gift tax purposes. In a non-grantor trust, the trust is its own taxpayer, which opens a different set of possibilities, particularly around which state's tax law applies to the trust's income. A trust established in a state with no income tax on trust income, administered properly by an independent trustee in that state, can mean the income it earns is taxed at the federal level but not at the state level, regardless of where the beneficiaries actually live. These structures have specific names: spousal lifetime access trusts, dynasty trusts, incomplete non-grantor trusts, and each one is built for a specific set of goals. The details matter enormously. The concept is what I want you to walk away with today. And then there's the piece almost nobody in the middle class ever considers: the private foundation. Families with significant assets often set up their own charitable foundation, a legal entity they control that exists to give money away and that comes with its own set of tax advantages to the assets contributed to it. The family decides where the charitable dollars go, the family often remains involved in running it, and the assets that fund it get treated for tax purposes in a way that's dramatically different from money sitting in a personal account. I want to distinguish the private foundation from something that more people have heard of, which is a donor-advised fund, or DAF. A donor-advised fund, or DAF, is a simpler, lower-cost vehicle. You contribute to it, get an immediate charitable deduction, and then recommend grants over time to the nonprofits of your choice. A private foundation is a heavier lift to establish and maintain. There are minimum distribution requirements, administrative costs, and compliance obligations, but it gives the family significantly more control. The family can employ family members in administrative roles. It can make grants according to a specific family mission that evolves over generations. It can invest its endowment according to the family's values and strategy. For the right family, at the right asset level, it's not just a tax vehicle, it's a governance structure, a way of encoding the family's intentions into a legal entity that outlasts any individual member. Now I'll add one more layer here that most domestic-focused conversations leave out entirely. The multi-jurisdictional dimension of this shield doesn't stop at the state border.
For people with the flexibility to structure international business income, operate across multiple countries, or establish legitimate residency in more than one jurisdiction, the options multiply significantly. Countries with favorable tax treaty networks, territorial tax systems, or specific regimes for high net worth individuals have become serious considerations for a growing number of wealth architects in the past decade. I'm not talking about tax evasion, which is illegal. I'm talking about legal tax residency structures that are fully disclosed and compliant, just built in a way that takes advantage of the global variation in how income, capital gains, and estates are taxed. This is a conversation for someone who's already built the domestic foundation we've been talking about. But I want you to know the door exists because most people never even learn it's there until they're already in rooms where everyone else has been through it. Here's the thread connecting all three of these. Residency, trusts, and foundations are all fundamentally about where something legally lives. Not about hiding it, not about pretending it doesn't exist, but about choosing deliberately the jurisdiction and the legal structure that something sits inside of. The middle class defaults to the simplest possible answer for all three. Their income sits with them personally in whatever state they happen to live in, taxed however that state and the federal government say. The wealth building path treats every one of those defaults as a decision, one that can be made differently, on purpose, with the right guidance. This is also, I'll be honest with you, the shield where doing it yourself goes wrong the fastest. Establishing residency without actually changing your life in a way that supports it, or setting up a trust without the right kind of professional oversight, doesn't just fail to save you money, it can create exactly the kind of scrutiny you were trying to avoid. Which brings us to the most important part of everything we've talked about today. So where do you actually start? Because I know what's happening in your head right now. You're hearing asset-based credit, cost segregation, non-grantor trust, and some part of you's thinking that's for people who already have millions. And I want to push back on that hard, because that thinking is exactly the trap. The trap isn't a lack of money, the trap is a lack of structure. And the structure doesn't require millions to begin. It requires a decision to stop operating like someone who trades time for money and start operating like someone who builds systems that work independently of their time. That shift starts in how you think before it shows up anywhere in how you file. You don't need millions to start building this. You need a different relationship with the money you already have. Here's the 12-month version of what that looks like. The first 90 days are about information, not action. Find a tax professional, not the one who does your return in February and disappears, but someone who actively does planning year-round for people building toward these kinds of structures. The difference between a tax preparer and a tax strategist is the difference between someone who records what happened last year and someone who designs what happens next year. This single relationship is by far the highest return decision in this entire video because everything else depends on it. If you sit down with your current accountant and they've never mentioned any of the three shields we covered today, that's information. It doesn't mean they're bad at what they do. It means they're doing a different job than the one you need done. While you're building that professional relationship, start your own education in parallel. Not by reading everything you can find on the internet, which will mostly produce confusion and contradiction, but by getting fluent in the vocabulary we talked about today. Securities-backed lending, cost segregation, non-grantor trust, step-up in basis, 1031 exchange. These aren't esoteric terms. They're the language of the second pathway we talked about at the beginning. And becoming fluent in them changes what you're able to ask for, what you're able to evaluate, and what you're able to build. You can't architect something you can't describe. The next stretch is about your first asset base. If Shield 1, borrowing against appreciating assets instead of selling them, is going to matter to you eventually, you need appreciating assets first. That might mean redirecting money that's currently sitting in a low-interest savings account into a long-term investment account instead.
It's not glamorous, and it won't make headlines, but it's the foundation everything else is built on top of. The size of that base at the start matters less than the habit of growing it. The families we've been talking about today didn't start with the structure fully built. They started with one asset, protected it, borrowed against it when they needed to, added another, and repeated the process for years. The complexity came later. The discipline came first. Somewhere in the back half of the year, if it fits your situation, you start exploring Shield 2. Even something as modest as a single small rental property, evaluated not just for cash flow, but what a cost segregation study to do for it. Many people are surprised to find that the tax benefit on a modest first property, evaluated correctly, changes the effective economics of the investment significantly. The cash flow they thought was only okay turns out to look very different once the paper loss from accelerated depreciation is factored in. That first property isn't just an investment, it's an education. And by the end of the 12 months with your professional team in place, you start having the conversation about Shield 3, not necessarily executing a full trust structure on day one, but understanding what your options actually are, so that when your asset base grows, the structure is ready to receive it. Now, the pitfalls, because I'd be doing you a disservice if I left these out. The biggest one is sequencing. People hear about Shield 3, trusts, foundations, jurisdictional planning, and they want to jump straight there because it sounds the most sophisticated. But without an asset base and without professional guidance, that's like building the roof before the foundation. The second pitfall is what tax professionals sometimes call form over substance, setting up a structure on paper that doesn't actually reflect how you're living your life. Tax authorities have seen every version of that, and structures that exist only on paper tend to collapse the moment they're examined. Substance matters. If you establish legal residency somewhere, but you're actually living somewhere else most of the year, that's not a structure, that's a liability. If you set up a trust, but you're still behaving as though you personally own and control every asset inside it, the structure won't hold. The architecture has to be real, not decorative. The third pitfall is paralysis by complexity. Some people hear all of this, understand that it requires professional guidance, and use that requirement as a reason to delay starting indefinitely.
That's the same mental model that keeps people in the first pathway forever. The complexity doesn't go away, you just get more practiced at navigating it. And the cost of waiting, measured in tax drag accumulated year over year while you're still deciding, is usually far more expensive than the cost of getting the right team in place and starting imperfectly. Here's your challenge then, and it's the same one I'd give anyone sitting across from me at a table. Take 10 minutes this week, not this month, this week, and actually calculate what I'd call your tax drag, the gap between the effective rate you're paying right now and the effective rate of someone using even one of these shields well. For most people, just seeing that number written down is the moment everything shifts from interesting to I need to start, because the number is almost always bigger than people expect. And once you see it, the cost of an action becomes as real and as concrete as the cost of a bad investment. That's the blueprint. 3 shields, 1 fundamental mindset shift, and a 12-month path to start putting it into motion. The shields work, the math works. The only thing that doesn't work is continuing to operate as though the first pathway is the only one that exists, when the second pathway is right there, documented, legal, and available to anyone willing to learn the language and build the structure. If this gave you a different way of seeing your own financial position, do 2 things for me. First, hit subscribe, because next time I'm taking Shield 3 all the way to the next level. We're going to walk through exactly how a multi-generational trust is actually structured, step by step, using a real anonymized example so you can see what this looks like once it's fully built out. Second, and I actually want to know this, drop a comment and tell me which shield you're starting with. Type 1 if you're going to start by restructuring how you access cash from your existing assets. Type 2 if real estate and depreciation is where you're heading first. I read every single one of these, and they genuinely shape what we build next on this channel. And if you know someone who's been working hard, earning well, and still feels like they're standing still, send them this video, because the gap we talked about today isn't about how much someone earns. It's about whether they're standing inside a structure or standing next to one they've never been shown. We don't follow the market, we design the moat. I'll see you in the next one.